Welcome to the Accounting Superstar channel. This is the place to learn accounting. Glad you're here. I'm Professor Don Bush, and I've been teaching accounting for about 30 years and have been a CPA for about that long also. So today we are learning about an intermediate accounting topic, accounting for income taxes, deferred tax liability, example number 2. So here we go. We are dealing with, when we get to it, construction. A construction company you probably don't want to have work on your home. The first box is financial information according to generally accepted accounting principles. And when we get to a construction, does the percentage of completion method for their books. And what that means is as they complete the project, they recognize revenue. So they are recognizing revenue as they earn it. So in the first year, they earned $80,000 and claimed $80,000. Second year, $120,000, and so on and so forth. The grand total for the contract is $400,000. When is it a better time to give money to the IRS than when you get it? So the IRS would agree with that. In the first year, the revenue according to when we get to it, construction's tax return was $70,000. Now this is different than the $80,000 up above. And in the second year, it's $90,000, which is different than the $120,000 up above, and so on and so forth. So there's a discrepancy between their books and the tax forms, but that's okay. The IRS will eventually catch up. Now, the total revenue claimed, according to the tax code, is going to be $400,000, which is the grand total up here for the generally accepted accounting principles. Since each year's revenue is different, the amount of tax due will be different. For instance, the income taxes payable to the government is $2,000 in the first year, although when we get to it, construction is claiming $4,000 as income tax expense. So there's a discrepancy there. So they're writing down an expense of $4,000, but they only have to pay $2,000. But the IRS will catch up, and that's why it's called a deferred tax liability. In the second year, they have an expense of $12,000, but they're only paying $6,000, and the IRS will not be shorted. The IRS will eventually catch up. That's why it's called a deferred tax liability. In the third year, the same thing. They are writing down a tax expense of $14,000, but only have to pay $10,000. But no worries, the IRS is about to catch up. So in the last year, they had revenue of $70,000 on the percentage of completion basis, income tax expense of $2,000. This is going on their financial statements, but according to their tax return, it's a much different story, because with the tax return, the IRS wants you to pay taxes when you get the money. That's usually how the tax code works. So in 2004, the revenue, according to the taxes, was $130,000. And everything else is pretty much the same as up above. But the income tax payable is $14,000. So here's a huge discrepancy. When we get to a construction is claiming $2,000 on their financial statements as income tax expense, but they actually have to pay $14,000. Now the grand total amount of tax is the same either way you go. According to their books, the grand total is $32,000. According to their tax returns for the last 4 years, the grand total will be $32,000 also. So let's come down the page just a little bit. So this next little chart here is simply a summary. That's all it is. So we have income tax expense according to GAAP. Where'd that come from? It came from right up here. $4,000, $4,000, $12,000, $12,000, so on and so forth. Income tax payable, that came off the second chart. Income tax payable, $2,000, $2,000, $6,000, $6,000. And finally, the last line here is the difference between the two. So we have, for the first year, income tax expense of $4,000, income tax payable of $2,000. That's a difference of $2,000. That is our deferred tax liability. That is the amount that the IRS will eventually catch up and collect. 2002, it's the same story. Income tax expense $12,000, income tax payable $6,000. There's a difference of $6,000 that is added to the deferred tax liability, and the same thing happens in the third year. However, in the fourth year, this is when the IRS eventually catches up. So now, it is too bad that the IRS is catching up and they do have to pay those taxes, but at least they got to defer those taxes for a while. And that's valuable. If you know anything about the time value money, deferring taxes is a good thing. Evading taxes, not a good thing. So coming down to the journal entries. The journal entries are simple if you understand this so far. Income tax expense, $4,000 for the first year. I have it all color coded here. It's all in yellow. So in the first year, $4,000 income tax expense, income tax expense. Income tax payable, income tax payable. The difference is $2,000. It needs to be a credit. And that's another reason why we call it a deferred tax liability. Liabilities are credits. Coming down to the balance sheet. Deferred tax liability is $2,000. We got it right here from the journal entry, or you can get it right here from the chart. Coming over to the generally accepted accounting principles income statement. This is the financial statement for when we get to it construction, the income statement. Current tax expense here is $2,000. What is that? That's the amount of money that has to go into the government. It comes from right here. The current amount that has to go into the government. And then we have what is being deferred, $2,000. It all adds up to a grand total of $4,000, which matches the expense. Let's go down to year number 2. And it's color-coded also in blue. So the journal entry, income tax expense, $12,000. Where'd we get that number? We got it from right here. Income tax expense. Income tax payable is $6,000. Where'd we get that $6,000? Right from here. The difference between the two, and it needs to be a credit, is $6,000. So we're adding to the deferred tax liability. And that can be seen clearly down here on this generally accepted accounting principle balance sheet. This is just a little portion of the balance sheet for when we get to construction. So deferred tax liabilities, they're considered long-term liabilities, not current liabilities. The deferred tax liability is a grand total of $8,000. Where'd we get that from? Well, $2,000 plus $6,000 is $8,000. Coming over here to the income statement for when we get to construction. The current expense here is $6,000, and that's the amount of money that must be sent into the government this year. So $6,000. And what was deferred was another $6,000. It all adds up to $12,000, which is the tax expense. Coming down to the third year. Third year, it's all color coordinated. This salmon color. Income tax expense, $14,000. There you go. Income tax payable is $10,000. The difference is $4,000. So once again, we are adding to the deferred tax liability. And this is made clear here in the partial balance sheet. So deferred tax liability, which is a long-term liability, not a current liability, is $12,000. Where did we get the $12,000? Well, if you add up 2 and 6 and 4, you get 12. There you go. Here's the income statement. The amount due to the government this year is $10,000. We get that right from the payable. The amount deferred is $4,000. It all adds up to $14,000, and we are good to go. Let's go to the final year, 2004. So here we are. Income tax expense, $2,000. We get it right from here. And the amount payable is $14,000. We get it from there. And the deferred tax liability, we are reversing it out. How do we know we're reversing it out? Well, we need it to be a debit in order for this journal entry to balance. And it's being completely reversed out in this final year. And so on the balance sheet, the deferred tax liability is 0. It has been reversed out. Coming over here to the income statement, pre-tax financial income, $10,000. The current amount that needs to be sent into the government is $14,000. We get it right here. It's from the payable. And we're reversing out the deferred income tax liability, which means the expense according to GAAP will be $2,000, and it matches our journal entry right there. It also matches our chart too. So ladies and gentlemen, that is the story of deferred tax liabilities. Till next time, over and out.